Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. My name is Sava, and today we're going to discuss the Treynor-Black model, a very handy tool to inform your investment decisions. Last time, as you might remember, we applied valuation multiples to derive fair values for two British energy stocks, Royal Dutch Shell and British Petroleum. And we found out that their fair valuations are well above their current market prices, signaling that potentially their shares is going to appreciate very significantly in the future, and that these two companies are a very good investment. Again, the valuation multiples model gave us insight into that these stocks are a good investment, but it didn't tell us at which proportion do we need to allocate our capital between Royal Dutch Shell, BP, and other investments that might be available. Treynor-Black model does just that and fills this gap. Without further ado, let's move on to the spreadsheet and apply the Treynor-Black model. First of all, as we compare market price and fair value, we need to make an assumption about how fast would the market price converge to its fair valuation. And there can be a number of assumptions made, but mostly we just eyeball it. And let's say that the share prices would rise to their fundamental value in 3 years. So it's going to be 36 months. And then we can calculate alpha, so abnormal return related to the fact that these stocks are undervalued. To do that, we just need to divide the fair value by the market price, and we'll have the rate of total appreciation. So how much higher is the fair value corresponding to the market price? Then, as the stock price will converge to the fair value in 36 months, we need to raise this appreciation rate to the power of 1 over 36 to get monthly appreciation rate, and to get the abnormal return, which is alpha, we need to subtract 1. And we see that the alpha for Royal Dutch Shell is around 1.28%. It means that Royal Dutch Shell is expected to outperform the market 1.28% per month. Then we can apply the same for BP, and we can see that the alpha for BP is a little bit lower, as the magnitude of undervaluation of BP is a little bit lower. Then we need to calculate the beta of Royal Dutch Shell and BP. To do that, we need to calculate total returns of those two stocks, as well as the respective benchmark. The benchmark is the market index of a country where those two companies are listed, headquartered, and where they mostly operate, which is the UK benchmark broad market index FTSE 250. So to calculate total returns, we've got total return indices over here. So to calculate total returns, we just need to apply the famous and very easy return formula, dividing the price currently by the price last month and subtracting 1. And then we can apply that for all 3 series, for all 60 months we have data for. And now we can calculate betas. So betas show how much is a particular stock exposed to its respective market index. To calculate that, we need to use the function slope in Excel, select the returns for Royal Dutch Shell, and then we need to put the market returns, which are the returns of FTSE 250. And as the benchmark is the same for both stocks, we can just lock the array of returns of FTSE 250. And we see that the beta of Royal Dutch Shell is 0.38. It means that if the return of the benchmark increases or decreases by 1%, the return of Royal Dutch Shell will respectively increase or decrease by 0.38%. It means that Royal Dutch Shell is more of a defensive stock. It moves in smaller magnitude respective to the market. So if the market goes up, Royal Dutch Shell goes up to a smaller extent, but if the market goes down, Royal Dutch Shell also goes down by a smaller magnitude. If beta is lower than 1, it means the stock is defensive. If beta is higher than 1, it means the stock is aggressive. Then we need to apply beta for BP as well, and remember, as we locked the area of returns for FTSE 250, it will automatically calculate it for BP just by dragging it around. And we can see that BP is also a defensive stock, but not as defensive as Royal Dutch Shell, as it exposed to the market risk of FTSE 250 to a slightly greater extent. Now we need to calculate the abnormal returns of Royal Dutch Shell and BP. To do that, we need to subtract the expected returns of Royal Dutch Shell and BP, each of the months that we have data for, from the actual observed returns in these respective months. So we subtract from the observed return the expected return. The expected return would be just the beta of the stock, and we need to lock the row here as the beta is the same for all of the months, but it's different for our stocks. And we multiply that by the return of the benchmark in these respective months. And we need to lock the column here as the return of the benchmark is the same for both stocks, but changes month to month, obviously. And we apply this formula and we get the abnormal return for Royal Dutch Shell in December 2014. And we can drag it for BP as well. And then we can bottom right click and get abnormal returns for all of the months we have data for. Now we need to calculate idiosyncratic variance. Idiosyncratic variance is called so because it is the variance of the abnormal return. Variance, or risk in finance, consists of two main parts. Systematic, the part of the risk that is attributable to broad market movements, and idiosyncratic, the part of the risk that is inherent to this particular company, that is associated with events that happen within the company that are impactful for this stock alone. So to calculate idiosyncratic variance, we need to apply the sample variance formula, var.s, to the area of abnormal returns of each of the stocks. We can see that the idiosyncratic variance for Royal Dutch Shell is a little bit lower than the one for BP, but they are quite similar and comparable. Now we need to calculate the appraisal ratio. The appraisal ratio relates alpha, so idiosyncratic return, abnormal return, how much the stock is overvalued or undervalued, according to the expected return given by beta in relation to its respective market, to the idiosyncratic variance. So it is just alpha divided by idiosyncratic variance. And we can see that our appraisal ratio for Royal Dutch Shell is a bit greater than the appraisal ratio for BP. Appraisal ratio is the measure of risk-adjusted return. The higher, the better. And appraisal ratio is the main tool, the main indicator that guides our investment decision in the Treynor-Black model. We need to weigh our actively managed capital proportionately to the appraisal ratios of our stocks. So to figure out how much of our actively managed capital we need to invest in Royal Dutch Shell, we need to divide its appraisal ratio on the sum of all appraisal ratios of the stocks we have alphas for, that we deem undervalued. And we see that we should allocate a little bit over 70% of our actively managed capital to Royal Dutch Shell, and slightly below 30% of our actively managed capital towards BP. Now we need to square those active weights. This is just a simple technique that we will use to calculate some indicators later on. The main conclusion is that if we dedicate some fraction of our portfolio to an actively managed strategy, to an active strategy, a strategy that seeks to pick undervalued stocks and thus beat the market, those are the proportions of the capital that we need to dedicate towards each of those two stocks. Now we need to calculate the alpha of our active portfolio, and the alpha is just the sum product of alphas of our stocks and the proportions of the capital we allocate towards them. Obviously, if we allocate everything towards Royal Dutch Shell, our alpha will be just the alpha of Royal Dutch, same for BP, but if we allocate our capital in some proportion, our alpha of the active portfolio will be the weighted average of the two. And the same applies if we have more than two stocks. So our active alpha is a little bit above 1%. Now we need to calculate our active beta, which analogously would be the weighted average of betas. And then we need to calculate our active volatility. Our active volatility would be the idiosyncratic variance of our active portfolio. And to calculate that, we need to weigh the idiosyncratic variances by active weights squared, as it's just the formula for weighted variance when the variances of idiosyncratic variances of two stocks being independent. And the Treynor-Black model makes this assumption that some of you might consider questionable, that the idiosyncratic volatility of Royal Dutch Shell is independent of the idiosyncratic volatility of BP, as the events that affect those companies and only those companies that are not translated into the effect of the market are independent of each other. If this assumption holds, then the volatility of the active portfolio will be the weighted average using the squared active weights. And we see that our active volatility is lower than both of the volatilities of the stocks, and this is the effect of diversification. A very famous free lunch that we have in finance. Diversification allows us to get a return that is similar to the returns of individual stocks, but have the levels of risk that are much, much lower than the individual risk profiles of the stocks. And this is the main idea of diversification, and this is one of the building blocks of modern portfolio theory. Now we need to compare our actively managed portfolio to another investment opportunity we have. Another opportunity that we are having is to invest passively, just investing in a broad market index and enjoying the return of the market. How better is our active strategy that we elaborated based on valuation multiples to the obvious alternative by just investing in the passive portfolio, which is the market index, and comparing the attractiveness of those two options, we can determine how much of our total capital we will allocate towards the actively managed portfolio and how much we will leave to manage passively. So to do that, we need to calculate our market return, and as we have our return data for 60 months, we can just calculate the geometric mean of monthly returns. To do that, we need to apply the product formula, and we need to apply product formula to 1 plus all of the 60 monthly returns of the benchmark. That will give us the total rate of appreciation of FTSE 250 over the 60-month 5-year period. Then, to calculate the geometric mean, the average monthly return of the benchmark, we need to raise that to the power 1 over 60. So this will give us the average monthly rate of appreciation. And to find the average monthly return, we need to subtract 1. As we do that, we need to enforce the formula, and as that is a matrix multiplication formula, we need to enforce that not just with enter, but with simultaneously holding shift and control and pressing enter. So all formulas like that involve matrix multiplication have to be enforced using shift control enter. And we see that we get our average monthly market return at 0.69%. Now we need to calculate market variance, and that is just applying the sample variance formula to the market returns. And we see that our market variance is a lot smaller than the idiosyncratic variance of both of our stocks and even the active volatility of our active portfolio. Which means that from the risk perspective, investing passively is much more attractive. Now, we need to find the excess market return. The excess market return is the difference between the average expected market return and the risk-free rate. And this idea revolves around calculating the risk premium. So, how much of an extra return do you get by investing in a risky asset compared to a risk-free alternative? And the risk-free alternative is usually a respective government bond. So arguably bonds of developed countries like the US or the UK are virtually default risk-free, so you could invest in them and get the yield that is virtually risk-free, as those sovereign borrowers are very, very unlikely to default. So the current yield of a UK government bond is 0.79%, but this is annual yield, so to make it comparable we need to convert it to a monthly frequency. So to do that, we calculate the rate of annual appreciation will be just 1 plus annual return. Raise it to the power of 1/12, as there are 12 months in a year, and subtract 1 to get the return. And we can see that our monthly risk rate is 0.07%, which is rather negligible, but still, for additional accuracy, we can apply that. And to calculate excess market return, we need to calculate the premium that the market pays over the risk-free alternative. And it would be the market return minus the monthly risk-free rate, and it is equal to 0.62%. Now, we need to compare the risk-adjusted performance of the passive portfolio and the active portfolio to determine how much of our capital we need to allocate towards actively managed investment. To do so, we need to divide the risk-adjusted performance of our active portfolio, which would be our active alpha divided by our active volatility. And this would be our numerator. This is how attractive, adjusted for risk, is our active investment. We need to divide it by the risk-adjusted performance of the market, so the passively managed part of our portfolio. And that would be the excess market return divided by the market variance, the market volatility. So return divided by volatility, or return divided by standard deviation, those are very common measures of risk-adjusted return when you compare the investment attractiveness of different portfolios or stocks or indices if you know that their risk profile is different. And applying this formula, we can see that the uncorrected active weight, so the proportion of the capital that we need to allocate towards our active investment, so towards those two stocks that we valued last time using valuation multiples, is above 76%. But now, to be even more precise, we need to correct that figure to the beta exposure of the active portfolio. The idea is that if the beta of the active portfolio is very low, then you will get very, very small return out of the market exposure of our active portfolio. So if our beta is high, then our active portfolio becomes even more attractive, and if our beta is low, then it becomes slightly less attractive as the risk premium of the active portfolio is low. So adjusting for that, we need to divide our uncorrected active weight by 1 plus 1 minus the beta of the active portfolio times the uncorrected active weight. And we can see here that this weight will decrease if our beta decreases and increase if our beta increases, exactly to capture this relationship between the beta of the active portfolio and the risk premium that we absorb by investing in it. And we can see that as our active beta is lower than 1, our corrective active weight is lower than our uncorrected active weight. And this is the final figure. The Treynor-Black model tells us to invest 52% of our capital into the actively managed portfolio. And as we only invest into the actively managed portfolio and the passive fund, the passive index fund, we need to subtract this from 1 to get the weight, so the fraction of our capital that we need to invest into a passively managed benchmark, the passively managed fund that tracks FTSE 250. And now we can finally calculate the weights of all the 3 investments that we consider executing. So it's Royal Dutch Shell, BP and FTSE 250. The weight of FTSE 250 is equal to the passive weight, and the weights of Royal Dutch Shell and BP are equal to the corrective active weight times the active weight of this particular stock. So as we allocate 52% of our capital to active investment and 70% of our active investment towards Royal Dutch Shell, we need to multiply the 2 and get the amount of total capital, the proportion of total capital that we invest in Royal Dutch Shell. And we apply the same for BP, and we find that we need to invest 37% of our capital into Royal Dutch Shell, 15% of our capital into BP, and 48% of our capital to FTSE 250. And that's how you apply the Treynor-Black model to determine the relationship between your actively managed portfolio that you form based on the valuation technique you applied to a number of stocks, and the passive portfolio, so the part of your holdings that you manage passively and just invest in the market index. Hope it was helpful. Please remember to subscribe, leave a like if you found it helpful, and in the comments below, leave more suggestions about what you want me to cover next. Thank you very much and stay tuned.